Well, hello, everyone, and welcome to our fourth in the series of presentations entitled Building a High-Performing Development Program. My name is Diana Gordon, and I'm president of ARCS Foundation Oregon, the sponsor of this series of talks that feature topics related to creating organizational capacity to focus on strategic relationship building with individuals and funders that have the ability to make significant philanthropic investments. For those who may not know, ARCS Foundation is a woman-founded organization that provides funding to academically outstanding PhD students in science, technology, engineering, and math. I'll pop our website URL and my personal email into the chat if you'd like to know more about how we do this. This series of informational talks has been developed by Lori Slaughter, who has served as the executive director of ARCS Foundation Oregon since 2022. If you have attended any of the prior Lunch and Learn sessions, you know that Lori is a seasoned professional in the world of philanthropy, and particularly in the area of major gifts. She brought 25 years of experience with her when she joined us at ARCS Oregon, and we have been trying to catch up with her ever since. We are immensely grateful for her strong and inspirational leadership in this area, and very proud to share her with you through this series of talks. I'm going to turn it over to Lori now to introduce today's topic and featured presenter. Lori?
Thank you, Diana. I really appreciate hearing you talk about me is a little odd, but it also just inspires me to continue the work of growing a strong development program from a very solid foundation here at ARCS Foundation Oregon. So welcome, everyone, and I'm really excited about today's presentation. We have an incredible professional with us, and she's going to share tons of good information. Before I introduce her, though, I just wanted to touch on planned giving. So why should we care about planned giving? Now, Rochelle will give you a lot more detail on that in her presentation, but I just wanted to touch on a few of the key benefits for nonprofits and for donors in the world of planned giving. So most of us understand that planned gifts can secure an organization's future. They are the highest return on investment program in fundraising. One study showed that for every dollar spent on fundraising bequest gifts, organizations can expect a $56 plus return on that. And in comparison, special events typically return $3.43. So another huge benefit for us in the nonprofit sector. Planned giving also has shown that it increases an organization's annual giving. Now that may seem counterintuitive, and I think early in my career I used to believe that planned gifts might cannibalize my annual giving program, but in fact it has the opposite effect. Also, bequests are accessible to everyone. Not everyone can make a major or a principal gift to an organization, but most everyone can make a bequest gift. And then the other key benefit to nonprofits is that planned giving expands the opportunities for contributing beyond cash gifts. A few benefits to donors in the planned giving arena. Donors can create a legacy for themselves and their families through planned gifts. They can secure tax benefits through planned giving vehicles for themselves and their heirs. And then people can do this with major gifts as well, but donors can impact the areas and causes they care most about even more with planned gifts. So that's why, it's really important as small organizations for us to try to find a place to include planned giving in our overall fundraising program. Now, I am so excited to introduce our guest speaker, and I'm going to turn it over to her in just a second. So we are so honored to have Rochell Makela-Goodman with us. She is the Assistant VP of Gift Planning at my my old stomping grounds, OHSU Foundation. Rochelle leads a team of fundraisers and implements strategies to unlock complex assets and expand the reach of gift planning program through team capacity building and direct marketing. I was looking at your bio, Rochelle, and it's extensive, but I calculated that you've been doing philanthropy for over 31 years. So we are really delighted to have your expertise here. Prior to Rochelle's role at OHSU, she served as the director of gift planning at Princeton University. And in a conversation with her, she shared the transformation that she and her team made at Princeton's plan giving program, where they increased productivity and performance on every measure, from revenue raised to donor engagement to the number of new donors and legacy society members. Rochelle also diversified the advisory committee for Princeton's plan giving program, and her creative work designing and implementing a virtual plan giving webinar series earned the Grand Gold Award from CASE. So I didn't know that either. I just was delighted to hear that about you, Rochelle.
That was fun.
Yeah. As I touched on earlier, Rochelle has a long history in fundraising, including in corporate and foundation relations, and also major and principal giving. Prior to her work at Princeton, Rochelle had fundraising positions with increasing responsibilities at Lehigh University, eventually serving there as Assistant VP of Leadership Gifts and Assistant VP for campaign for that university. I could go on and on, but I really want to hear your presentation on plan giving, Rochelle. So I'm going to turn it over to you. And for the audience, we'll be checking the chat. So if you have any comments or questions, please pop them into the chat and we'll bring them into the conversation.
And Lori, can you help me monitor the chat? Because I'm afraid I can't see all the screen. Once I share screen, I think I'm going to lose some of the ability to control the Zoom.
Absolutely.
Okay.
I'm on that.
And fine for people to speak up and to ask questions as we're going along. Are you seeing the slides in the right way?
Yes.
Okay, terrific. All right, well, it's wonderful to be here with you. I've heard about some of the great work of the ARCS Foundation through my colleague, Jamie Brown, over my 2.5 years here. And, so grateful for your work and your support of women scholars. So thank you for giving me the time today. We'll just jump right in. Let's see if it's going to advance. Okay. So, there's a little bit of contention out there about what constitutes a planned gift, and there's no agreement on the definition. It's really funny. Every shop defines them slightly differently, but we typically think of planned gifts as gifts that are made at death. And those are the most common ones I've listed here on the left-hand side. But it can also mean a significant number of current gifts that the charity can put into use today. And they often come through the plan giving operation because they're complicated. They're a little bit more complicated than an outright gift of cash or publicly traded stock, let's say. And I've listed some of those on the right-hand side. They include gifts that pay a donor or the donor's beneficiaries income for life or for a term of years. I've set these up for people who've set them up for a graduate student for 5 years while they're in grad school. And then, there's whatever's left over in the account goes to the charity, for example. So that's definitely a gift that a donor can make during life. But an increasingly popular one is gifts of real estate. We've been seeing a lot of action in that area. Business interests, private stock, tangible property, and different kinds of property like, and I would say at OHSU, the most popular thing we get offered is gifts of art, which carry their own set of IRS rules and regulations. So they're an interesting asset to work on. But I would say what all of these kinds of assets share in common and the plan gift kind of approach is that they use tax and financial planning considerations in bringing in the gift. And these gifts are often being presented by a donor who has some either life event going on, personal and philanthropic goals that they're trying to achieve. And in most cases, we're trying to work through tax problems like appreciated assets that the donor would otherwise incur a large capital gain bill if they tried to liquidate them themselves. These appreciated assets present a great opportunity for nonprofits like yours and like ours. So we're always trying to find ways, and we're constantly learning about ways to maximize the value and reduce the cost of the gift to the donor. So another reason we pay attention to planned gifts in the nonprofit world is because of their growth potential. And Lori touched on a lot of this, and I'm so glad you mentioned the ROI on every dollar spent for a gift planning program, because they are a meal deal in that regard. The downside is, though, they require some patience, but they are an increasingly representing a larger and larger portion of fundraising revenue totals across the country. So bequest gifts alone represented 46 billion in 2022, and they're expected to continue to grow. Planned gifts also allow you to tap into non-cash assets such as real estate and the art, which I mentioned. Lori mentioned, they democratize your donor pool because a donor of any wealth level can usually participate in a gift of this kind. But I would say one of the most important things is they give you program resilience. So in economic downturns, and I've lived through 3 of them now in my fundraising career, the dot-com crisis, right, and a couple of other recessions. It was planned gifts at those times that kept our nonprofit buoyed while donors were feeling the uncertainty and the stock market was down and they didn't have liquid assets to give. We were bolstered by the planned gifts that came in, the estate gifts primarily. And then I did want to mention the Great Wealth Transfer, which is an area that we've been hearing about. Oh, I've also included a slide here. I forgot I put this in at the last minute. This just is an interesting chart from CCS fundraising that shows you the multiple of how much larger planned gifts are to the donor's annual gift, average annual fund gift to you. So, and you can see the multiples there on the right, and it's pretty significant. At Princeton, we used to use, our formula was 8 to 20 times, and it was times their lifetime giving. So we didn't look at their average annual fund gift. We said, if this donor has reached the age of 70 and they've given us $100,000, it was a pretty safe bet to estimate on our potential cash flow that this could be $1 million or more estate gift easily. And that I had 150 years of data too at Princeton, or actually 250 years of data, and it proved pretty true. So very helpful to your organization's planning, and also underscores the point that Lori raised, that you get a tremendous amount of ROI if you invest in one of these programs. I mentioned the Great Wealth Transfer. I apologize that I didn't have time to refresh this slide. So this is one from 2015, but data from 2015. But the point is the same, that you can see this is birth rates in the United States going across the generations, going back to the greatest generation and silent generation. And you're seeing that the bequests that have been coming in and the planned gift totals that we see reported by Giving USA and these various data aggregating companies is reporting estate gifts from the silent generation primarily. But we are coming into an era now where the baby boomers, where there were many more people born, are reaching the life stage where they can do planned gifts. They will be setting them up now, and we're also going to start realizing them now. And because of this, it is estimated that somewhere between 40 to 70 trillion dollars is going to pass from the silent generation and the early baby boomers to the next generation. And philanthropy has a huge role in this, and we anticipate that we will be the recipient of many of these dollars as the generations transfer over. So a lot of charities are looking at this and trying to figure out how to position themselves. So now I wanted to shift gears for a second and just go into the most popular, the most common plan gifts and the benefits that we associate with them and how we communicate to different donor groups about them. Starting with the simplest and I think the most understandable, which are bequests, and that by bequests I'm specifically talking about wills and trusts here. So when you're thinking about who a potential bequest donor is, I've listed some of the characteristics that we just typically track upon when we're marketing these things. We know from the data that they're predicted more by giving loyalty rather than giving level. So donors who are repeat donors, even if it's $25 every year or a monthly donor of $10, tend to be more reliable plan gift donors and more open to playing gifts than the one-off, one large gift kind of profile. They have few or no children, typically. At least the largest bequests will come in from childless couples or people with one or fewer children in the household. It's basically no heirs. Widows and single women are more inclined to do bequests, and they do them more frequently, and they do them more generously than their male counterparts. I just thought this one was interesting, so I threw it in here. Pet owners give more than non-pet owners. Who knew? Actually, I think that makes sense because they're loving and giving. Now, what's starting to come into the fore are the behavior of online donors. And so I included that the age 45 to 65 group are using online tools for their giving. They're also just starting to use online will makers and doing their initial first bequests to charity through these platforms. However, my next to the last bullet there is a very strong reminder that the will that matters to your charity is the last will that is cast by a donor, which typically isn't done until they're around average age is 81. And this is important, right? Because part of the nature of setting up a planned giving program is that you have to be rechecking in and rechecking in and rechecking in with donors because the path is not straight, and they always have the opportunity to withdraw their bequest or change it or give it to another charity. And so you want to be checking in with them. They will be changing their will later in life. I mean, the pattern I saw at Princeton was they would notify us for the first time around age 65 when they're approaching retirement and thinking about retirement. They would give us very little information about what was in that bequest. They just say, I've set up a legacy gift for you, and we'd put them in the Legacy Society. About 10 years later, when they were 75, they would call us again and get into nitty gritty about allocation. And they're really thinking about their gift, and they're casting a new will because they realized there was a bunch of stuff they didn't think about at age 65. And then we'd get a call again, somewhere between age 81, and at Princeton, they think they're going to live forever. So they do it at actually 84. And they would call, and then you could tell they were really thinking about it and doing the real gift. So whatever you set up, just keep in mind that donors are it's an evolution with them. None of us really know until we're reaching the end what we really want to do. And our systems and processes have to accommodate that and embrace it. That we can't be upset by it because it's just the nature of the business. And of course, people who are older make the largest bequests. I don't think that's any surprise to anybody. When we get older, our other responsibilities to other family members have sunsetted, and we can be more generous with charities. So sorry, this thing doesn't like to advance sometimes without a few clicks. So the way we communicate these to our donors is we remind them that you can set up bequests any number of ways for a specific amount, a percentage of your estate, or the remainder after you've taken care of all of your other beneficiaries. And we're very happy and grateful for a bequest in any of those forms. We remind them that a bequest is a gift that costs you nothing now. we remind them that the donor can change their mind and work on work with a gift officer at our organization for a gift plan, and they can alter it down the road if they so choose. And we remind them, especially in the state of Oregon and Washington, where we have estate taxes, that setting up a charitable bequest can reduce their gift and estate taxes on their estate. And on the right here, I just took a screenshot of some of the information that I think every charity should have on their website in case a donor is working on a will or a beneficiary designation. Make sure that you have a little spot for them to go where they can get your legal name, your tax ID number, your legal address, because their attorney needs that, or they need that to fill out that beneficiary form. And then we give them sample language. And I gave you a little piece of it there. I give to Oregon Health and Science University, a nonprofit, incorporated in the state of Oregon. So whatever your sentence is, make sure they can get to that in a simple, straightforward manner without having to jump through a million hoops.
Rochelle, if I can
Yes.
interrupt for a minute, Jen Gill up in Seattle has a question, and I'm going to, Jen, you should be able to talk right now. So if you want to pose your question, go for it.
I'm sorry. I think I must have accidentally pushed a wrong button. So
Oh,
I didn't
okay.
have the question. Thank you.
Well, that's okay. We'll get you later. Okay.
Thanks.
Sorry to interrupt,
Bye.
Rochelle.
Quite all right. Quite all right. So the next category are beneficiary designations, and these are rapidly eclipsing wills and trusts because they don't require an attorney to set them up. They're usually just a simple form that your donor has to fill out with their IRA administrator or their life insurance company or commercial annuity provider. And another cool thing about these is that for charities is that they don't go through the probate process, right? They get to us usually a lot sooner because they don't have to wait to go through the court system. They're also, because they don't go through probate, I would say they're a little more private too. They're not, these amounts aren't in the public record like they would be if they're coming through a will. So, just remind you that people have a lot of money now in donor advised funds that they forget about. So we try to remind our donors in our annual fund mailings that our charity gratefully accepts donor advised fund grants and to remind them. But we also try to remind them of these other forms too, to name our charity in them. And I would say what we're seeing more and more too are pay on death and transfer on death gifts. And those are, when you're filling out, you're setting up a bank account or something, they'll often ask you if you want someone or some organization to receive the balance of your account upon death. And transfer on death is I'm seeing them in transfer on death deeds that people want to give us a real estate when they pass away, and it's done automatically when they set it up in this manner. Now, another really important way people are giving is through qualified charitable distributions from their IRA. I think we all know that, we're the generation, the great experiment that had to save our own retirement funds and walk away from the pension system. So there's a lot of savings holed up in these kinds of accounts. And savvy donors know when they're approaching age 72, 73, when they're going to be required to take their minimum distribution every year by the IRS, that this money is going to be taxed at the highest marginal rate at ordinary income rates. So it's confiscatory taxation on these. And further, savvy donors know, and maybe it's good to remind all your donors that if some donors mistakenly think they can that it's a good idea to leave these funds to their kids. These funds are going to be taxed just prohibitively if you leave them to a non-charity. There are smarter ways to set up retirement funds to your kids if that's what you want to do. It's a little more complicated than we have time to go into today, but basically you'd designate them to charity and then have an agreement with the charity to set up a charitable remainder trust or something like that to decant the money to the child, and then the remainder goes to charity. This year, the IRS the IRS's new rules to index the maximum amount that a person can give to charity from a qualified IRA has gone up from $100,000 to $105,000 per individual, and $210,000 if it's a couple filing jointly on their income taxes. It transfers to charity completely tax-free to them, and it counts toward their minimum required distribution. So it's a double win for them. They get the money out with, they don't get a tax deduction, but what they're getting is better than a tax deduction. It's actually reducing the cost of the gift more than they would if they had to recognize it for tax and then take an offsetting deduction. It may lower their tax bracket in future years. So I've talked to many donors and worked with many donors over the years who are looking to reduce the balances in these QCDs, but it's very hard to do during life. So QCD to charity is a solution for them, and one you do need to remind your donors of repeatedly. There are some rules. They have to be transferred correctly according to the IRA administrator's rules. Sometimes that's filling out a form. Sometimes that's working with their broker who's administering the IRA account, but just, make sure that the brokers know what they're doing. And I always remind donors, you have to follow the IRS's rules. I put the link to those rules here on this slide. And a reminder that you have to be at least 70 and a half or older to qualify for making a gift this way. The next category, Lori asked me to touch on our CGAs and CRTs. So we call these life income gifts. These are the most popular structure of a gift where a donor transfers an asset, usually it can be cash, but it solves a huge problem for donors who have a highly appreciated piece of real estate or are coming into a liquidity event on a business. Either they're selling their business or the business is IPOing, something like that. It allows donors to convert assets or cash into an income stream for life. So often donors are setting this up to augment and complement their retirement, provide some diversification in their income. It's a way really to diversify their retirement portfolio, sort of a fixed income alternative. It provides an immediate income tax deduction to the donor. So even if they're not taking the payments immediately, they're setting it up now. They get the tax deduction now, perhaps when they need it more because they're still earning, or they have, larger tax bills at this present time, but they can also be structured so the income stream doesn't start for 5 years or 10 years, or there's even contracts that allow them to decide at a later date when they want the payments to turn on. And there are different tax benefits to the different ways you structure it. The way I describe these to donors is, they tell us their goals and we can adjust the dials to either maximize the benefits on the front end with a larger income tax deduction, or we can adjust the dials to maximize income on the other side to themselves or their beneficiaries on these things. They can now be funded with a QCD from an IRA, but only up to $53,000 this year. So unfortunately, charities got all excited because the proposal to Congress was to make them for $400,000 maximum. 53,000 is a lot different than that, but it is something we have done about a half dozen of those this year. Just again, I think it signals that donors are desperate to get these funds out in a tax efficient manner. And if in the charitable gift annuity, the CGA form, the rates are the highest that they've been in over 10 years. So they're very attractive for that reason too, because donors who lock in now will lock in at a pretty high rate. Now, one thing I wanted to mention, Lori and I talked about this in prepping for this talk. I know you don't currently offer life income gifts, but there are some partners, I'm going to mention some of them at the end of this, where smaller charities can use an outside administrator to help them offer these kinds of gifts without having to take on the full burden of running the program themselves. So just keep that in mind as we're moving forward. There are just a couple of extra slides. I won't belabor this, but these 2 slides here just show you pictorially how a gift annuity works. So I think can you see my cursor when I do this? Does it?
Yeah. Yes.
Okay. So what I'm showing here is that the donor gives, in this case, an appreciated asset let's say it's appreciated stock and they have a very low basis of, they only paid 200,000 for it, but it's now worth $1 million. If they sell it themselves, they have an $800,000 capital gain they're going to have to deal with. But let's say instead they donate it to your charity. If they donate the stock to your charity, the charity is qualified, does not pay capital gains. So the full $1 million goes into the investment account of the CGA and starts generating income for the donor or the donor's named beneficiaries without any tax penalty. So you're basically generating income on the gross instead of the net. If they tried to do this diversification themselves, they'd have the net only to invest. So this runs for the donor's lifetime, and it can be up to 2 covered lives, up to two lifetimes. And just in this scenario, I used a one life, a person age 85 with a 15-year time horizon. I'm assuming this woman is going to live to age 100, which is not all that unusual right now. And I'm assuming that our investment return is earning about 6% annually. So that's a very conservative earning. So these are low numbers, is what I'm saying. The benefits would probably be magnified in real life, but the donor in this case would get an immediate income tax deduction of almost $600,000 for conveying that stock that they paid $200,000 for. They would avoid the net tax on the $800,000 gain is for almost $500,000 in capital gains that they didn't have to pay. They're going to receive $80,000 a year in life income, or $1.2 million over the 15-year time horizon. And at the end of this thing, when they pass away at age 100, the charity is going to get $500,000 toward our mission. So I'm going to pause there for a second. I know that was a lot to take in, but I included this slide and we'll share it with you as part of the handout so you can take some time to look at it.
Rochelle, can you talk about the second life on these? So if
Sure.
this person wanted to add their daughter or their son to this as a second tier beneficiary, would that be workable in a CRT, in an annuity?
Probably not for an annuity, because annuities are have to be done for life. They can't be done for a term of years. So there's no way to control for, so they don't work for younger people. But this version, the CRUT version, it absolutely can be done. So depending on the challenge, the goals or the circumstances that a donor presents, you may have to lean toward one of these structures over another. But it's very common with a CRT, a charitable remainder unit trust, which is what I put up now, to have the donor's life covered. So it makes payments for the donor's life, and then a succeeding generation for a term of years. So that way you can put controls on it. The IRS has there's a lot of rules and regs about making sure that these things are not boondoggles, and that they are likely to yield a charitable remainder at the end. So they have to pass various remainder tests. There's called a 10% federal test and things like that. And so a younger beneficiary would fail the test, but you can usually tweak the term on the second generation to make it work.
Right. And is there a maximum time horizon on the first life or the second life?
Technically, no. The IRS, for the annuity version that has to be for life, follows the 2010 mortality table. So they're basically using by formula what the same thing that the life insurance companies are using is it. And I'll just add, I should have mentioned, a lot of donors ask me, what's the difference between doing a charitable annuity and doing a commercial annuity? Because my broker is talking to me about a commercial annuity. And I think the easy answer is to say they're very similar. The payout rates are usually very similar, although the for-profit industry is coming up with exotic products all the time. But the difference in a nutshell is what would have been the profit that goes to Prudential or the insurance company is instead going to the charity. That's the difference. And with a commercial annuity, you are not going to get an immediate income tax deduction for setting up a commercial annuity, but you will with a charitable annuity. So, that's, I think an easy way to keep the difference straight in your mind. This slide, I won't spend as much time on this one, but a CRUT works basically the same way. I have the same $1 million stock with the same low basis. It gets transferred to the charity. The charity pays no capital gains tax, so the donor gets income based on the gross, not on the net. Um, the donor can be assured that they're going to have expert investment management. The houses that charities partner with to look at these investments and watch them every day are very, very good, and also good at managing the distributions to the donor every year to make sure that the donor is not paying too much income tax on the distributions they're receiving for their lifetime. In this case, in the case of a CRUT, same scenario, one life, a donor age 85 with a 15-year time horizon. The donor gets a higher deduction using this vehicle. It's a $701,000 deduction, $800,000 in capital gains, avoid taxation, and the beneficiary receives a 6% payout or $883 back to them over their lifetime at this rate of appreciation up here, the 6%. And under this set of circumstances, and like I said, if you're thinking about one of these things for yourself or a donor, remember that the dials can be adjusted in any number of ways to change the outcomes depending on what your goals are. But in this scenario, there would be $1 million left for the charity in this case.
So Rochelle, we had at UCLA, I had a donor with a real estate, a capital gains problem with a piece of real estate. They purchased a condo in Santa Monica in the 60s, and and they wanted to sell and move closer to their family in San Diego, and they were going to incur over $1 million of taxable income from that sale. And they wanted to make it a gift to, we ended up not doing it because what they wanted to do was a little cumbersome for us. But they did do it through another community foundation, I believe. They set up something like this, but they had multiple charities. I think they had 5 charities that they wanted to distribute to. And that was the reason that we had them partner with another type of foundation to make that happen, because we weren't in that business as a supporting foundation for one university. So I just wanted to ask you about putting more than one charity as beneficiary, final beneficiary on these types of
It's
vehicles.
very common, and I would say and another truism about these is that the donors, a lot of times, especially at my previous institution at Princeton, the donors were setting up these CRUTs on their own and self-trusteeing them, and they were naming our charity as one of maybe 2 or 3 charitable beneficiaries on them, and that's fine. What the law says is that if the charity is trusteeing it, and we'll do it both ways. And I recommend, your charity too is probably already the beneficiary of some of these structures that are being trusteed by other administrators. So we're very grateful for these gifts, but the law says if we were to trustee it, which sometimes the donors ask us to do because they get older and they can no longer handle the tax burden of it, and they don't want to they can't watch the investments every day like we can. We can become successor trustee, and so could you, but the law says we must, in order to do that, you have to be at least 51% charitable beneficiary. The other charities have to have a minority stake. In other words, they want to make sure, the IRS wants to make sure you have skin in the game and that you're going to be watching both benefits as a fiduciary for both the donor, for their life income, and for the charitable remainder.
Thank you for that. I mean, so many of our donors are have interest in multiple causes, so this may come up in our conversation.
It's a really great solution for, especially, you know, people who are coming into a windfall. This is probably the go-to playbook for,
Mhm.
you know, people who are, you know, have early investment shares on a, you know, private shares of a company that's IPOing or things like that. This is the go-to. So I thought I'd have a little fun for a second and just show you some of the cool gifts that I've had a chance to work on since I've been at OHSU that kind of bring in some of these concepts. So the first one here is a retained life estate. This is where a donor gives you the deed to their house, but they retain the right to live in it. And in this case, the charitable value on this arrangement was $400,000. So that was a gift from about a year ago. We also took in private stock, which is a very interesting journey. But I'm starting to learn as a newbie to the Pacific Northwest that Vancouver has quite a active entrepreneurial you know, environment up there, and that's where this came from. We've also done a couple of interesting commercial properties. So one was a gift of a Burger King in Texas, which was a pretty wild one, and the proceeds from our sale of that, so we took it in after a lot of due diligence. We're able to liquidate it within about 2.5 months, and it was a $3.2 million gift and part of a blended gift that the donor added to as well. And then we just recently liquidated a property in Washington County, commercial office building for 3.5 million. And I was also a lot of fun, and each one kind of has its you know, it's like birthing a child. Each one has its own set of trials and tribulations and is unique. But as I started to mention there, the really good stuff comes when you're blending these things. So I couldn't find a good image for blending, so we're here at a DQ Blizzard. So just to give you an idea of some of the common ways these things are stacked is, you know, a donor will present, and maybe they've been loyal to you and they've done many annual gifts over time. They want to do something special. They want to start an endowment fund with your organization. Let's say they convey appreciated stock to you worth $100,000. They establish a gift annuity that's going to help them with their retirement. They'd like to give you this money now, but they can't because they're not quite sure what they're going to need for, you know, their living expenses down 20 years from now. So they set up this gift annuity. They can do qualified charitable distributions from their IRA every year. And here I put the maximum at the time, this was last year's slide, of $100,000 a year for 5 years. That's $500,000. And then capping it off with a beneficiary designation from their IRA, whatever's left in there, let's say, or a specific amount, and a bequest gift. And you can see how very quickly you can get to a gift plan. These are not mega gifts in and of themselves, but you can get to a very significant legacy, you know, pretty quickly by thinking about how to blend these things up. So I know this talk is about considerations of how to start a program. So I wanted to shift over to some of what I think are some of the requirements that you'd have to think about. One is a really good system for saying thank you to these donors, because as we mentioned before, these gifts are revocable in many cases. And so it's our money to lose. I always, you know, me and my staff are always talking about that, as how do we make sure we can retain and keep these donors in good stead. Well, legacy societies are the typical way that that's done by charities. And, you know, they take many forms, but sometimes it's just a system or a calendar of thank you calls and letters that are going out. It's sometimes having a newsletter or a dedicated website that features stories about people who have made planned gifts. Thank you events. So we do a donor thank you luncheon for all of our Legacy Society members, and we do a medical chat, because one of the assets that we have that we can offer to our donors, they're these smart doctors who talk about things that our donors are interested in. So we try to set up those talks a few times a year and invite our Legacy Society members. And then inclusion on some kind of honor roll. And what I've included here is just a snapshot of, you know, this is a photo from one of our Legacy Society luncheons. that we hold every year. We invite our gift officers, our leadership from the Hill at OHSU, and it's just a wonderful, wonderful annual event. On the right, I'm giving you a snapshot of our welcome form to the Guild. Now we're rebranding it as the OHSU Legacy Society, so this will change. But basically, we send them, when they've notified us that they've put OHSU in their estate plan, we send them a welcome letter with this form saying it's optional, but if you would tell us a little bit more about your gift, we'd really appreciate it. And then we, of course, use this to inform our stewardship going forward. Another thing you're going to have to think about is marketing. Planned giving requires marketing. And I will say this is my least favorite part of my job because I didn't get into fundraising to think about marketing plans, but it's a necessary evil in this case. You just won't be successful without it because awareness is a huge part of a successful planned giving program. And let's face it, taxes, nobody likes to think about death and nobody likes to think about taxes. But we have to find ways to communicate it and communicate it in ways that are accessible to people. So I think that ends up being a huge part of my job. I'd say 50% of my job is thinking about how to communicate these opportunities. It's also watching the market and thinking about what's going to be attractive in the coming quarter. So sometimes you're going to have to pivot and change your marketing to, when life income rates were really low, it didn't make sense to talk about them all that much because the payout rates were, 3.5% or something, and donors wouldn't find that particularly compelling. So sometimes you're pivoting from different kinds of structures to another.
Rochelle, can you touch on how important donor stories are to your marketing plans? I see this
I
all
think
the
they're
time.
magical.
I've done it before, but I think it's easy to overlook it if you're not tuned in.
Yes, yes. So we try to, as new gifts come in, it's one of the questions it's usually a preliminary question to ask that donor, would you consider allowing us to do a profile on you? Can we, include your photo? And this is why, because your gift will inspire others. And we try to change that up to make sure that we're getting yes from a person who's done a real estate gift, and yes from a person who's done a life income gift, and yes from a person who's set up a bequest gift. So we can make sure we're holding up the right example at the right time.
Right.
But I just think they're magical, and I think they also contextualize the tax solutions and the family financial solutions that a donor is struggling with in a way that other donors can relate to. So I think they're really, really important. As I mentioned this briefly at the beginning, that there are partners with whom you can work that take some of the burden of running these programs off the shoulders, especially for small shops. And so I sort of categorize them by what I think are their strong suits, but some of these places do more than one kind of support for you. So gift planning marketing, we use Stelter at OHSU. They host our website for us. So when you click on gift planning at OHSU, you're actually being spun off to a Stelter hosted website. The reason I do that is because I just don't have time to keep ours legally correct all the time. When Congress changes things and formulas change and IRS discount rates change, they have the sea of attorneys that are just watching this stuff, and it's their job to make sure that it's always up to date. But there are other companies that do it as well, including Pantera, Crescendo. PG Calc, I think, is amazing, and they're really great for smaller shops because they're much less expensive. They will also host your website. They provide excellent marketing support, and it's legally correct, and they're just considered the wizards in life income too. So I think they're wonderful to work with. The Sharp Group and plannedgiving.com are slightly different kinds of marketing support. They are places where you can just buy brochures by the box and have your name stamped on them and have them at the ready for explaining to a donor who wants a little bit more information about what if I gave you my house, or what if I gave you appreciated stock, or so they're just kind of nice to have because these are time consuming for small shops to create. And even I would say, we're a rather large shop, and we still buy some of these things off the shelf from these vendors because we just don't have time. I'm an office of 4, so um,
I've used Sharp Group for brochures in the past, and it's really quality stuff, and it is
yes.
affordable. Mhm.
Yeah, I think they're really good. And will making services. So we are just sticking our toe in the water. We've signed up with Giving Docs because they have a partnership with Stelter, and we're now offering a free making service for OHSU, any donor who presents, but in there, they're asked the question, would you please consider a bequest to OHSU while they're going through the process? And then we get notified only if they agree to letting us know the details of their gift. But another company that does that, that's getting quite famous now, is Free Will. Free Will is about 5 times 6 the price, I'll just say. So
Now
I,
we went with Free Will at Outside In, and I was really blown away by the number of younger donors.
yes.
30 somethings and 40 somethings were making bequest intents to us.
Yes, I think you can really bolster. It's a great way to get started, I think, because the younger people will do their will this way. They're
Mhm.
inclined to do everything online anyway, and it's very accessible for them. Not so sure. I'm going to be very interested to track ours to see how many of our retirees are going to jump onto this tool.
Yeah,
Um,
it's not good for complex people who have complex assets certainly need a lot more, but
right.
for democratizing the world of bequest giving, I think for people who don't have, a ton of things, assets and complexity to their
Yeah,
portfolio.
I
This is
agree. I think I
a
agree
good
it
way forward.
democratizes it.
Mhm.
And then if you're interested in building a life income program, there's a number of ways you can do it. I mean, uh, Lori already mentioned like partnering with a community foundation, or they community foundations can offer tremendous help. But there's Charitable Solutions is a firm that helps charities with complex assets, not just life income, but if you have like a business interest or an airplane being offered to gift or a yacht, these things are um, scary for nonprofits because they bring a lot of potential liability to your nonprofit that we're not usually resourced to handle. So you can connect a donor to Charitable Solutions, and they have their own foundation. And what they'll do is do all the due diligence for you. For a fee, they will bring it into their Decami foundation. So the donor gets the charitable receipt and doesn't have to pay any kind of cap gains or anything on the transfer. And then they liquidate it for you and send your charity the cash um, proceeds after taking their
Mhm.
fee. And I've worked with them on a number of complex asset gifts. They're really good. They really know their stuff, especially if you get offered business interests. I think it's I like to say to donors, say, well, I don't want to pay a fee. Why don't you do it, Rochelle? And I'm like, well, I can do it, but I do actually see one of these through about once every 3 years.
Mhm.
You get them presented to you, but usually what will happen with gifts of business interest is there's either some debt on the company or something like that that fouls the gift, and their CPA will eventually figure out that, as Brian Clance would say, the juice is not worth the squeeze. Um, and so it's much better to work with a company that does literally Charitable Solutions does, I think it's 5 a week at their firm. So they really have seen everything, and I sell it to the donor by saying, you want to pay this fee because they've seen everything that can come down the pike and they can help you. Um, PG Calc will also help, of course, with the life income um, kinds of gifts. There's administrators out there who help you with the investment management, the tax prep every year. That includes TIAA CASPIC. We work with US Bank for those services, but I've worked in the past with BNY Mellon. They were excellent. And also with Bank of America. So, and I'm sure there's many others, but just so you know, you're not alone. You can get help if you want to launch one of these programs. Um, I think when you're thinking about the marketing, it's also, thinking about how to tell these stories through the lens of what your donor cares about. And, um, you know, I would say you throw a lot of spaghetti at that wall. It's all valid. I think donors present with all kinds of, we've gotten great gifts from donors who are very transactional and are just strictly thinking about the tax savings. And then we get a fair number of gifts of, from people who are complete altruists who, the tax benefits are nice, but that's not what's motivating them. And I think you just, make sure you're looking at your communications and kind of checking all of those boxes so you're not leaving any money on the table. And I wanted to wrap up with policies and procedures because I think this is where a lot of charities can get tripped up. If you have to be thoughtful on the front end because these gifts, like I said, are can change. And if you're going, a big one is, do you count it now? Some charities, more and more charities are opting to count and celebrate bequest intention gifts while the donor's alive before it's realized, even though the gift can be taken away. We do that at OHSU, by the way. It's very different from where I came from, and I'm still learning the good, the bad, and the ugly of it. But I will say, you do it for the reasons of you can provide better stewardship to the donor, and the research shows that if you steward it well, all the things that Lori talked about at the beginning, you will make better annual fund donors out of them. They will give you more during their lifetime, and you'll get a bigger bequest for this process of good stewardship, right? More than what they originally perhaps presented with. So there are these are solid reasons for why you should consider celebrating them earlier. And it's something to think about. But also, I would say, think about this. Sorry, this is not a great graphic, but I worked for years to try to explain this to people, and I think this is the best way I could come up with. The relationship with the donor is not a straight success line, right? It has its ups and downs, and a donor will go through cycles with you and your charity. They'll start by making annual fund gifts. They might, in their 60s, tell you, okay, I've checked you, I've put you in my estate plan somehow. I'm not going to tell you any details, but you put them in your legacy society and you start stewarding them for that future bequest gift. Maybe 10 years later, they give you more details and they're asking you about, oh, how much is your minimum for setting up an endowment fund? And what if I want to allocate these planned gifts to a specific legacy idea? And then they get angry with you about something and they write you, and you get that notice saying, you have a faculty member who did something I don't like, and I am writing you out of my will. And I keep those letters. What I think is really interesting about them is that Princeton, we called it Hate Mail Monday. I'd get my hate mail, and all the people who told me that they wrote us out because Princeton said something in the press or did something. And then a couple years later, I'd reach out to that donor and say, I'm really sorry. Well, actually, I'd reach out to them immediately and say, I'm really sorry you feel that way. Are you sure? You want us to do this? And is there anything we can do? And then usually they'd be too angry and say no. And then 2 years later, they'd call and say, I really want to come to the legacy breakfast. And I'd say, does that mean we're back in the will? We can put you back in the legacy society? And so here you are again. You're back on track with your donor. And it's very hard to build systems with nonprofit systems, being what they are. We don't have a tremendous amount of resources for databases and updates and stuff. It's hard to track on this stuff. It really is. So just know that on the front end, because this is what it's really going to look like.
Yeah, buckle up, Buttercup. It's gonna be
Buckle
hard.
up. Right. I think it's worth it. I think it's the most rewarding work. I feel like our relationships with plan giving donors, the things that you're talking about, legacy, how they want to be remembered, how they want to take care of their friends and family, how they want to take care of their favorite charities, deepens the relationship and just enriches it for both sides of the table, right? For you as the fundraising body, and for the donor as well. You're going to make lifelong friendships with these people. You care about these people. It's hard when you're dealing with older people too, and many of them, every week a good friend passes away. That's hard.
Mhm.
But I'm content in knowing that we help them realize this important goal. So I left you a couple of other interesting slides that I found in the CCS fundraising report for last year that are just some trends, and I thought they had this very nice succinct executive summary. It's very hard to read on a slide, but you'll have it in your handouts. Some of it I agree with, some of it I don't, but I think it's good food for thought regardless. Now, let's see if I can figure out how to unshare.
Thank you so much, Rochelle. I feel like we could talk for another 5 hours.
I
You
know, I
have
love
so
talking
much
about this stuff.
wisdom and knowledge. And I don't see any questions in the chat. I'm imagining everyone is just kind of taking all of this
Yeah,
in
it's a lot.
and trying to process, not only for ARCs, but maybe for themselves too. You probably ping some people to think about things. I did want to, Alex is reminding me to remind the audience about our last session, which is coming up. I think it's March the 15th. 14th, Thursday, the 14th from noon to 1. And we're going to talk about grants in general, the current environment. And we are going to be joined by Carol Schmeike, who is the development director for ARC's Northern California chapter. And she was a longstanding grants professional in higher education before she came to ARC. So I'm looking forward to having a chat with her on that. But Rochelle, I can't thank you enough. I know you're super busy, and we are so delighted that you came and shared this with us. You've given us a lot to think about. I'm going to
Well,
turn
I
it
hope it was
over.
helpful.
Oh, very.
And I
Yeah,
think you have the slides. So if you need anything, any questions come up, I'm happy to address them. Just ping me. You know how to reach me, Lori.
I do.
Thank you. Thank you, Diana. And thank you all the
Thank
members of
you,
ARCS for everything
Rochelle,
you
and
do.
thank you all in the audience for joining us. And we look forward to seeing you in just 2 weeks. And with that, go forth, be awesome.
Love it.
Bye.